Hello and welcome to this week's Market Focus Fundamentals on 14th of November 2011. I guess the only place we've got to start is in Italy, really, with overnight and weekend proceedings. Mario Monti was handed the task on Sunday night to form an emergency government led by technocrats as Italy's head of state raced to win a broad political consensus before the markets opened this morning. Giorgio Napolitano, the 86-year-old president, who has been instrumental in guiding Italy through its political crisis, formally asked the previously unelected Mr. Monti to take charge less than 24 hours after Silvio Berlusconi resigned as Prime Minister after Parliament's approval of some reforms demanded by the EU. So who is Mr. Monti? So Mr. Monti is a former European Commissioner and has yet to be, and obviously he's yet an unnamed cabinet expected to be dominated by technocrats, all chosen from outside the Parliament. He could be sworn in by this Wednesday and then could seek a formal vote of confidence in both chambers. Obviously, Italy had to move very, very fast. From last week's, it seems like going from one country in Greece, which has certainly subsided in terms of the news that's coming out of Greece. The attention was quickly drawn last week to Italy, and obviously the 10-year bond notes in Italy, which were touching very crisis levels really last week, and hence the reason why the Italians really have woken up and smelt the coffee, if you don't mind the pun, because I mean, Italy really is one of the biggest economies in, let alone Europe, in the world, and the problems they were facing, they've actually moved quite fast on this. Berlusconi's been there for what seems absolutely ages now, and unfortunately, the confidence has not been there, and there's going to be some harsh decisions in Italy. And Mr. Monti, he certainly knows his economics. He's come from an economics background. He's head of one of the largest economic universities in Italy, and he's also a former ex of Goldman Sachs. So, in terms, it seems like the right man at the right time for this particular job. Although saying that, it's not going to be plain sailing as you'd obviously imagined. The market certainly last week had prices in, as you saw on Friday, the vicious rally we saw in some of the US equities and the global European equities, and even this morning it seemed like the price has, well, that news was actually priced in last week, and we've somewhat actually tailed off, and I think reality is certainly hitting home. Although, you know, Italy's moved fast in terms of getting the right man in place to hopefully at least trying to sort out some of the mess that's been going on in Italy. As we know, this austerity measures, as Greece has found out, is not going to be plain sailing. And for my money, it's going to be a lot harder in Italy. There's going to be lots of cuts. It's a long, slow road. It's yet to be seen, and again, you know, there's going to be plenty of twists and turns in this road, and you know, although the markets have been bullish in the last few trading sessions, one feels that there's always going to be certain spanners in the work that will be coming out somewhere fairly soon. So, you know, certainly it's worthwhile keeping a note on what's certainly happening out there on the news wires. But that really is the latest and the most important headlining front. As regards this week, it's if I just take you to our calendars, the UK economy really, inflation comes into focus, and it has in recent months settled into a period of stagnant growth with stubbornly high inflation, yet the Bank of England has maintained that the factors holding consumer prices close to or above the 5% are temporary, and this week it gives its latest assessment. So before the bank delivers its quarterly inflation report out for July to September period, this will be on Wednesday, The October CPI, which is also published on Tuesday, is expected to show the annual inflation ease fractionally to 5.1% from September's 3-year high of 5.2%. The retail price index, which hit a 20-year high of 5.6% in September, is expected to remain at this level in October. And the bank believes firmly that inflation will fall rapidly next year, possibly even below its 2% target rate. And this was justification for its decision last month to pump an extra $75 billion into its asset purchase scheme to help save the stalling economy recovery. Well, basically, against the backdrop of the flash estimate of Europe's third quarter gross domestic product, which is published also on Tuesday, most expect the annual rate of growth to have slightly risen as Germany remained relatively robust, but see a weakness accelerating through its fourth quarter. Indicators of the industrial activity in the US will be scrutinized as the New York Federal Reserve published its monthly Empire State Manufacturing, and also that is out on Tuesday, and the Philly Fed posts its correspondent report on Thursday. So we've got a fairly top-heavy week here in terms of its US data. Wednesday also brings the publication of the US National Industrial Production figure for October. And back to UK on Wednesday, employment data, should I say, for September is likely to show further deterioration in the labour market. So that's really this week's economic reporting. And obviously, as you've seen, we have seen considerable volatility in these markets, and Europe is seriously still paving the way in terms of the direction of these markets. Although things are progressively moving forward, it seems as though Greece has ironed a few creases out, and so is Italy. One always has to be concerned about what's really coming out next. So I'll leave you with that thought, and happy trading, folks, and we'll speak to you next week. Thank you very much.